Welcome to AG John Show. What you're witnessing right now is not a normal market reaction. It is a system reacting to the sudden loss of certainty that it relied on for far longer than most people realize. Today did not begin with fear. It began with disbelief. Disbelief that the assumptions holding everything together could be challenged so openly and so forcefully. For years, markets were trained to respond to stress the same way Pavlov's dogs responded to a bell. Every sign of trouble was followed by reassurance, liquidity, and return to order. That pattern created confidence, but it also created dependency. And dependency quietly turns into fragility. What broke today was not price levels, it was expectation. Expectation that no matter what happened, someone would step in and smooth the outcome. When Trump moved against that expectation, the reaction was immediate. Not because markets hate him, but because markets hate uncertainty more than bad news. Gold falling shocked people, because gold is supposed to rise when trust erodes. But gold does not exist in a vacuum. It exists inside a leveraged financial system. When leverage is forced to unwind, logic takes a back seat to mechanics. Assets are sold, not because they are wrong, but because they are liquid. Silver collapsing made no sense to those watching supply and demand. But paper silver trades emotion long before physical silver trades reality. Bitcoin selling off disappointed those who believed decentralization should thrive during institutional stress. But Bitcoin, when held by institutions, behaves like a risk asset before it behaves like a statement. This was not a rejection of these assets. It was a forced liquidation of exposure. Most people misunderstand what actually moves markets during moments like this. It is not opinion, it is obligation. Margin calls do not care about narratives. They do not care about long-term theses or ideological alignment. They demand cash, immediately. And whatever can be sold fastest becomes the victim. This is why everything fell together. Not because everything failed, but because everything was needed. Trump did not need to crash markets to send a message. He needed to introduce doubt into a system that priced in obedience. The Federal Reserve's power has never been absolute control. It has been perceived control. Perception is fragile when openly challenged. For the first time in years, markets are questioning whether the referee is still neutral. And once that question enters the room, the game changes. The old system was built on predictable responses. Inflation rises, rates adjust, markets fall, liquidity appears. That predictability removed fear. But it also removed discipline. Discipline does not disappear quietly. It disappears slowly, then returns violently. Today was discipline knocking on the door. Kevin Warsh's name matters less than what his appointment represents. It represents uncertainty in a place where certainty was assumed. Markets can handle bad outcomes. They cannot handle unclear authority. When authority is unclear, capital does not seek growth. Capital seeks shelter. Shelter does not mean safety, it means flexibility. And flexibility requires selling first and thinking later. This is why the move felt fast and indiscriminate. Speed is a symptom of forced decisions. People are already trying to simplify what happened. They want to label it an overreaction, a buying opportunity, or a temporary correction. Those labels are comforting, but they are premature. Comfort is not analysis. Corrections happen when markets adjust expectations gradually. This move happened because expectations snapped. Snaps do not resolve in one session. They echo. What comes next will not be linear. You will see rallies that feel convincing and sell-offs that feel unfair. Both will be misleading if you do not understand the underlying shift. The shift is not economic, it is psychological. The psychology of guaranteed rescue is fading, not gone, but questioned. And when guarantees are questioned, leverage becomes dangerous. For over a decade, leverage was rewarded. Risk management was optional because losses were socialized. That era trained people to ignore downside. Downside never disappears, it accumulates. Accumulated downside is released all at once. This does not mean collapse is inevitable. It means complacency is no longer free. Free money creates bad habits. Bad habits create fragile systems. Fragile systems break loudly. Right now, the loudness is being mistaken for finality. People are assuming the move defines the future. It does not. It reveals the present. The present is a market unsure of who will step in when things get uncomfortable. That uncertainty alone is enough to change behavior. Behavioral shifts move capital faster than fundamentals ever could. This is why charts feel useless during moments like this. Technicals assume stable rules. Rules are being renegotiated. The Federal Reserve now faces a problem it cannot solve with language alone. Language worked when trust was intact. Trust is no longer unconditional. Every statement, every hint, every delay will now be interpreted through suspicion. Suspicion widens, spreads, and shortens time horizons. Shortened time horizons increase volatility. Volatility feeds emotion. Emotion creates mistakes. Most participants will respond emotionally. They will sell weakness and chase strength. That behavior transfers wealth. It does not protect it. The people who survive transitions are rarely the most confident. They are the most adaptable. Adaptability begins with honesty. Honest assessment of why you own what you own. If you own assets because they always went up before, you are exposed. If you own assets because you understand their role in a broken system, you have context. Context matters more than conviction right now. Conviction without flexibility becomes stubbornness. Stubbornness is expensive in transitional markets. This moment is not about being bullish or bearish. It is about being prepared. Prepared means understanding that volatility is no longer an event. It is a condition. Conditions persist longer than events. Gold, silver, and Bitcoin were stress tested today. Stress tests reveal structure. Structure determines survival. Paper structures failed faster than physical realities. That distinction will matter later. Later is not today. Today is about survival, not victory. People asking for clear answers are asking the wrong question. Clear answers only exist in stable systems. We are not in a stable system. We are in a system reassessing who is in charge. That reassessment will not be smooth. It will be contested. Contested authority creates fragmented markets. Fragmented markets punish assumptions. If you assume tomorrow will behave like yesterday, you will be wrong. The only safe assumption right now is that behavior has changed. Changed behavior changes flows. Changed flows change prices. Understanding that puts you ahead of most participants. This is not the end of anything. It is the beginning of repricing belief. Belief moves faster than data. Data follows later. If you are calm right now, that is an advantage. If you're scared, that is information. Fear tells you where you are overexposed. Overexposure is a choice. You can correct it. The market does not punish patience, it punishes urgency. Urgency makes you trade the noise instead of the signal. The signal today was simple. Control is being questioned. When control is questioned, nothing trades the same way. What you do with that understanding will define how you experience the next phase. Most people will ignore it. A few will adapt. Adaptation is how wealth survives transitions, and this transition has only just begun. What happens after belief is questioned is always more important than the moment belief breaks. Markets can absorb shocks, but they struggle to operate without a shared framework. Right now, there is no shared framework. There are competing assumptions fighting for dominance. One camp believes intervention is inevitable because it always has been. Another camp believes intervention is politically constrained and therefore delayed. Those two beliefs create opposing trades that cancel liquidity instead of stabilizing it. That is why price discovery feels chaotic. This environment rewards neither optimism nor pessimism. It rewards preparation. Preparation means recognizing that narratives will lag reality. By the time consensus forms, positioning is already done. This is why following popular sentiment during regime shifts is so dangerous. Consensus always forms after opportunity disappears. Markets are forward-looking only when the future is familiar. When the future is unfamiliar, markets become defensive. Defensive markets behave differently. They overshoot, they reverse sharply, and they punish certainty. Certainty is the most expensive position you can hold right now. People want to know whether this is a buying opportunity or the start of something worse. That question assumes a binary outcome. Transitions are not binary. They are messy, uneven, and emotionally draining. You will see days where everything rallies and confidence floods back in. Those days will feel convincing. You will also see days where selling resumes without warning. Those days will feel irrational. Both are expressions of the same thing. A system trying to find a new balance. Balance cannot be forced. It emerges only after weak positions are cleared. Clearing weak positions takes time. Time is what most participants don't have patience for. This is why forced selling tends to cluster. The weakest hands are always closest together. Once they are gone, markets behave differently. Volatility compresses, correlations loosen, and signals improve. We are not there yet. Anyone telling you that this move cleared the excess is guessing. Excess is not measured in price, it is measured in behavior. Behavior changes slowly. It resists until pain forces adaptation. Right now, pain is selective but growing. That is the most unstable phase. Selective pain creates denial. Broad pain creates capitulation. Capitulation has not happened. What you're seeing now is disbelief. Disbelief sounds like confusion, debate, and argument. You see it everywhere. People arguing about personalities, policies, and projections are avoiding the deeper issue. The deeper issue is trust. Trust was the lubricant of the system. Without it, friction increases everywhere. Friction raises costs. Higher costs change incentives. Changed incentives change strategies. Strategies that worked in a low-friction environment fail when friction rises. This is why some funds will struggle even if markets recover. They were built for a different regime. Regime shifts do not destroy all wealth. They redistribute it. Redistribution favors those who understand the shift early. Understanding does not mean predicting exact outcomes. It means recognizing constraints. The biggest constraint right now is credibility. Once lost, it is slow to rebuild. The Federal Reserve cannot declare credibility back into existence. It has to earn it under pressure. Earning credibility often requires allowing pain. That is the paradox. If pain is avoided, credibility erodes further. If pain is allowed, markets react violently. There is no painless path forward. This is why this moment matters. It is not about whether assets go up next week. It is about whether the system chooses comfort or discipline. Discipline is politically unpopular but structurally necessary. Comfort is popular but fragile. Markets are beginning to sense that this choice can no longer be delayed. Delayed choices create larger consequences. That is why moves feel exaggerated. They are pricing not just what is happening, but what was avoided. Avoided consequences always arrive with interest. This is also why comparisons to past corrections are misleading. Past corrections happened within a trusted framework. This is happening during a framework transition. Framework transitions change how risk is priced. Risk premiums expand. Expanded risk premiums mean lower valuations, even without bad news. This catches people off guard. They expect prices to reflect earnings or growth. But valuation is not just about growth. It is about confidence in the system that supports growth. If that confidence weakens, multiples compress. Compression looks like unfair selling. It is not unfair. It is repricing. Repricing does not care about your entry price. It cares about future stability. Stability is not guaranteed right now. That does not mean instability is permanent. It means stability must be proven again. Proof takes time. Markets demand evidence, not promises. Every rally will be tested harder than before. Every dip will feel heavier. This wears people down. Fatigue causes mistakes. Mistakes accelerate transitions. This is why emotional discipline is critical now. Not optimism, not pessimism. Emotional neutrality. Neutrality allows you to observe without reacting. Observation reveals patterns. Patterns are forming, but they are subtle. Watch what recovers without headlines. Watch what fails despite good news. Those divergences matter. They tell you where confidence still exists and where it has evaporated. Confidence is selective now. It is no longer universal. Selective confidence creates opportunity, but only for those who wait. Waiting is hard when everything feels urgent. Urgency is the enemy. The system wants you emotional. Emotional participants provide liquidity. Calm participants preserve it. This is why silence can be a strategy. You do not need to act every time the market moves. You need to act when the market reveals something meaningful. Today revealed something meaningful. It revealed that belief is no longer unquestioned. That alone changes everything. The next phase will be about testing limits, political limits, monetary limits, social limits. Each test will create volatility. Each test will teach the market something. Those lessons will accumulate. Eventually, a new equilibrium will form. It always does, but the path to equilibrium is not smooth. It is defined by overreactions in both directions. If you can survive that path without forcing decisions, you gain an edge. Most people lose not because they were wrong long-term, but because they were forced short-term. Forced decisions are almost always bad decisions. Avoid being forced. That means managing exposure, managing expectations, and managing emotion. This is not about timing tops or bottoms. It is about staying solvent and sane. Solvency gives you choice. Choice gives you power. Power in markets comes from patience, not prediction. If you understand that, you are already playing a different game. A game where survival comes first and opportunity follows. This transition will create stories. Some will sound convincing, others frightening. Most will be noise. The signal is simpler. Control is being renegotiated. Until that negotiation ends, volatility remains elevated. That is not a warning. It is a condition. Conditions require adaptation, not panic. Those who adapt quietly will benefit later. Those who react loudly will pay now. This phase will not last forever. It never does, but it will last longer than most people expect. If you respect that, you will not be surprised. And in markets, not being surprised is half the battle. The rest is discipline, and discipline right now is the most valuable asset you can hold. What finally ends phases like this is not reassurance, it is exhaustion. Markets stop moving violently when participants accept the new reality instead of fighting it. Acceptance does not mean agreement, it means adjustment. Adjustment is when behavior aligns with constraints. We are not there yet. Right now, most participants are still trying to force the old playbook onto a new environment. That never works for long. Reality always wins the negotiation. The next stretch will test patience more than intelligence. You will feel tempted to do something simply because doing nothing feels irresponsible. That feeling is the trap. Activity is not the same as progress. Progress in markets often looks like waiting while others make mistakes. Mistakes create opportunity, but only if you're still standing when they appear. Standing requires restraint. Restraint is uncomfortable in a world trained to react instantly. Instant reaction was rewarded in the era of constant liquidity. That era trained people to mistake speed for skill. Skill now looks slower. It looks deliberate. Deliberate does not mean inactive. It means intentional. Intentional positioning starts with asking hard questions. Why do you own what you own, and what problem is it supposed to solve? If the answer depends on a guarantee, you should reassess. Guarantees are being renegotiated. This does not mean abandoning conviction. It means aligning conviction with reality. Reality right now is fragmented confidence. Some areas will regain trust quickly, others will lag. Lag creates frustration. Frustration creates selling. Selling creates discounts, but only for those who can wait. Waiting does not mean hoping, it means preparing. Preparation includes understanding that volatility will spike around information, not clarity. Information without clarity increases disagreement. Disagreement fuels movement. Movement without resolution increases risk. Risk must be compensated. That compensation comes through price. Lower prices are not punishment. They are payment for uncertainty. When uncertainty declines, that payment shrinks. Prices recover not because things are perfect, but because they are understandable. Understandability is underrated. Markets prefer a bad plan to no plan. Right now, the plan is unclear. That is why reactions feel exaggerated. As the plan becomes clearer, even if it is painful, volatility will compress. Compression will not come from optimism. It will come from acceptance. Acceptance takes time. Time takes patience. Patience is hardest when headlines scream urgency. Urgency is the soundtrack of transitions. You cannot mute it, but you can choose not to dance to it. The most powerful move during periods like this is not prediction. It is survival. Survival keeps you optional. Optionality is leverage without risk. Riskless leverage sounds like a contradiction, but it is not. It is the leverage of choice. Choice allows you to act when others cannot. Inability creates forced selling. Forced selling is where value transfers, but transfers do not happen instantly. They happen after enough people give up. Giving up does not look dramatic at first. It looks like boredom. Boredom sets in when people stop checking prices obsessively. That is when markets begin to heal. We are not bored yet. We are still debating. Debate is a sign of disbelief. Disbelief precedes capitulation. Capitulation is loud, but clarity follows. Clarity does not mean prices immediately rise. It means prices begin to make sense again. Sense returns slowly. It arrives unevenly. Some assets will regain trust before others. Watching that sequence matters. Do not chase what is loud. Observe what is quiet but resilient. Resilience is revealed under pressure. Pressure exposes strength. Today exposed fragility. Tomorrow will expose adaptability. Adaptability is the trait that wins transitions. Rigid strategies break. Flexible ones bend. Bending feels like weakness to the ego. It is strength to capital. Capital does not care about pride. It cares about survival. Survival buys time. Time buys perspective. Perspective prevents regret. Regret is expensive. It lingers longer than losses. Losses can be recovered. Regret compounds. The goal right now is not to be right today. It is to be positioned for when clarity returns. Clarity always returns. It does not announce itself. You will recognize it because volatility will feel different. Moves will feel earned, not forced. Until then, caution is not cowardice. It is wisdom. Wisdom is quiet. It does not chase validation. Validation is scarce in transitions. That is why people argue louder. Loud arguments do not create truth. They create noise. Noise exhausts people. Exhaustion leads to mistakes. Mistakes clear markets. Cleared markets reset. Reset is coming, but not on a schedule. Schedules belong to stable systems. We are not in one. What you are witnessing is history repeating in a new costume. The details change, the pattern does not. Periods of excess are followed by periods of discipline. Discipline always feels unfair at first. Unfairness creates anger. Anger creates opportunity for those who remain calm. Calm is not indifference. It is controlled attention. Control your attention and you control your behavior. Control your behavior and you control your outcome. Outcome control is rare in markets. Behavior control is not. Focus on what you can control: exposure, expectations, and emotion. Everything else is noise. This moment will be remembered differently by different people. Some will remember fear. Others will remember opportunity. The difference will not be intelligence. It will be behavior. If you take nothing else from this, remember this one thing. Markets punish urgency and reward patience during transitions. Transitions do not end with a bang. They end with acceptance. Acceptance is quiet. When it arrives, you will feel less compelled to act. That is when the best opportunities begin to appear. Until then, survival is the strategy. Discipline is the edge. If you found this breakdown useful and you want to stay ahead of these shifts as they unfold, make sure you're subscribed so you don't miss what comes next. These moments don't reward speed, they reward understanding. And understanding comes from staying engaged without getting emotional. Stay patient, stay aware, and I'll see you in the next one.